Hello students and welcome to this explanation on PPE and investment property and going between the two. This question is called NPD and it says that they own several properties since its incorporation. The properties consist of land and buildings that cannot be sold or leased separately. And then they give you an extract from the books of NPD as on 1 January 2015. So there's land and buildings at cost. This is very important to pay attention to the word at cost. Then they've given you some random retained earnings, some share capital, and then investment property at cost as well. In the first note, it says, land and buildings consist of plot Sunnyside, building Art Club, and a head office. In 1.1, they say plot Sunnyside was acquired for 8 million rand on 1 July 2020 and had a fair value of 9 million rand on 31st December 2014. The property had been occupied by the sales department since its acquisition. On 1 April 2015, the building was leased to tenants under an operating lease for a rental of 1.2 million rand per annum, which is monthly payable. The fair value of the building on 1 April was equal to the carry value. In 1.2, it says that building Art Club is situated in Potchefstroom and has been utilized as a training center for employees since it was acquired on 31st December 2011 at a cost of 18 million. The building was revalued to 20 million rand on 31st December 2014. The building has been vacant since 1 January 2013 as a result of closure of the training unit due to financial difficulties faced by the company. On 3 January 2015, the property was leased for 100,000 rand per month to the South African Football Association as a crisis management center. In 1.3, the remaining land and buildings represent the company, the head office of the company. The property was purchased on 1 January 2007. It is the policy of NPD Ltd to measure land and buildings based on the revaluation model by revaluating the asset at the beginning of each financial year based on the net replacement method. So the previous questions that we have done have mainly been directed towards revaluating or revaluations done at the end of the year. So now we will explore what happens when revaluations are done at the beginning of the year. Then it says depreciation on land and buildings are written off over 25 years on a straight line basis and no residual value applies. Investment properties are measured based on the fair value model. Scrolling along, it says in note number 2, the investment property is situated in Mafeking as indicated above and has been leased to the Northwest Department of Health since 1 January 2008. The rental per annum is 2.1 million rand and the fair value of the building on 31st December 2015 was 15 million. So you will observe that they have given you the cost price of this investment property to be 12 million. In the required part, it says for 15 marks, you need to record all the necessary journal entries for the year ended 31st December 2015 in respect of all the above assets, journalize cash, our bank and debtors as well. Alrighty, quite an interesting question. Let's see how we are going to sort out this question. I am just going to open an Excel spreadsheet. And let's start. So I am going to basically break it up in terms of the names. So the first journal entries that I want to do, let us just clearly indicate debit and credit. The first journal entries that I am going to do is for plot Sunnyside. And it seems to me like this was investment, this was PPE, but it became investment property on 1 April 2015. So I'm just making a note for myself. It used to be PPE, but now we are taking it to investment property. Let's see. The first journal entry that we will do is the revaluation of the asset on the first day on the first day of this year, which is 1 January 2015. So what you will observe is that they have given you the purchase date and they've given you the cost price. They said it was purchased on 1 July 2012. So we need to go and complete our steps in terms of revaluation. However, we will not be measuring depreciation at the beginning of the year, but depreciation will be measured as for the year ended 31st December 2014. You will also notice that they've given you a fair value for 31st December 2014, which is the previous year or the last day of the previous year. And this is because the revaluation needs to be done at the beginning of the year. Therefore, the fair value on 1 January 2015 will be the same as that of 31st December 2014, because we do not consider in accounting a difference that a single day makes. So we're going to start by saying there's a number of calculations that we will have to do in order to be able to eliminate the depreciation, because the first step will be that we need to revaluate, which means that the accumulated depreciation needs to be taken out of our books, and this will be on, I'm just going to say sunny side, and we need to play it off against the asset, which is buildings sunny side. So the problem that we face in this question is that we do not have the accumulated depreciation that needs to be eliminated. So we need to do a calculation for that in order to know what we should eliminate. The purchase date of this asset was 1 July 2012. So I'm just going to count the months up till year end. So between, maybe we should write it rather as 1 July 2012 to 31st December 2012, which is the year end according to the required part, was 6 months. The next year was 1 Jan to 31st December 2013, and that was a whole year, so that's 12 months. Then we also have 1 January to 31st December, which is 2014, which would have been our previous year, and of course then the depreciation up till 1 January 2015, because 31st December 2014 and 1 January 2015 is basically the same thing. So that would have been a number, again, 12 months. So if I'm not mistaken, 12 and 12 is 24. You add another 6 months. It was a total of 30 months for which this asset was in use so far. So we need to eliminate the depreciation by using the 30 months. We're going to take the cost price of 8 million rand. You will observe that there is no residual value here. And we are told that it is a time frame of 25 years straight line. So we need to use that information. So I'm going to say it is 25 years and I'm going to times it by 30 months. If we do that, we can obtain the accumulated depreciation up till 1 January 2015. And that gives us 800,000 rand. Great stuff. In the next part of the calculation, we can then calculate the carry value, because the carry value will now be the difference between the cost price, which is the 8 million given, and the current accumulated depreciation of 800,000, which means the carry value of this asset is 7,200,000 rand. What is the fair value that needs to be used, or the net replacement value? It can also be the net replacement value. It is 9 million. It seems to me like we need to value this asset upwards. Currently in our books, it's displayed as 7.2 million. We should display it in our books as 9 million. So this is going to be a revaluation surplus, and it is the difference between these figures. And for this calculation, we're then going to say I am going to increase buildings, Sunnyside, and I need to recognize a revaluation surplus, which is of course other comprehensive income and thus an equity. Therefore, this 1.8 million is going to be reflected there. Right, so far so good. What remains to be done is that we now need to transfer it. I believe that it becomes on 1 April, let me just confirm the date, yes, 1 April 2015, it becomes investment property. So what needs to be done is we need to depreciate the asset between 1 January and 1 April. Maybe for consistency, I should just do this. 2015. And we need to first depreciate it up till the date that it should be now taken to investment property. So I'm going to debit depreciation and I'm going to credit accumulated depreciation on Sunnyside. Right. Now, the problem is that currently in our books, we have eliminated the accumulated depreciation, and the only thing that we have left is this 9 million rand that was displayed, and that I want to say, artificially changed so that it could be 9 million because that was the fair value. In measuring the depreciation now, we need to use this 9 million rand, and we need to go and find the remaining useful life of this asset. So this should not be as difficult because we already know we've used 30 months of its life. If we want to know what is the total lifespan of this asset in terms of months, we're going to say the total lifespan is 25 years with 12 months each. So there's 300 months in the total lifespan. So that's easy now to get to the remaining life, because the remaining life will be in months, the total span minus the 30 months that have already passed up till the date that we have last measured the depreciation. So there's 270 months that are remaining as part of this asset's lifespan. We're going to take the 9 million rand fair value. We're going to divide it over the 270 months, and then we need to times it between the months of January to April. So that would be January, February, and March, because April, it is the first day in April, and we don't account for a single day. So we're going to times it by 3 months. Please note how I don't divide by 12 now, because I've divided by months, so I'm timesing by months, and then I don't need to do a division. If I had divided by years, then I would put the 3 on a 12 so that we can have months and months or years and years when we divide and multiply. So it's 9 million rand divided by 270 months. We have used up 3 months of that, which gives us 100,000 rand. So the carry value in the books, because they tell us that the fair value of the building is equal to the carrying amount. So we need the carry value. So the carry value for this asset is now the 9 million rand, which we have revaluated it to, minus the 100,000, which is the current depreciation for the last 3 months. Once we've done this calculation, then we can actually recognize that there is a transfer to investment property. So therefore, we're going to take the investment property account and we're going to increase it. And we need to take out the building Sunnyside. So we're going to also eliminate the accumulated depreciation. Right, so we're going to increase the investment property by 8,900,000. We're going to take out of building Sunnyside the 9 million, which is reflected as cost now, and we are going to take out the accumulated depreciation on building Sunnyside, which was only this 100,000 rand, because all the others have, when we revaluated previously, we already eliminated all other accumulated depreciation. So this will be the only amount reflected in accumulated depreciation. Right, and there we go. It is now rented out, but we still now need to account for the lease payments. So on the 31st of December 2015, we account for the lease payments, which means we are going to increase the bank or the debtor. They do not state that it was for cash, and increase our rental income account. And now we need to be careful. I need to call it account. We need to be careful that it is for 1.2 million rand per annum, but we did not rent out this asset for the entire year. It was only, if you count with me, April, May, June, July, August, September, October, November, and December. So it was only rented out for 9 months. So I need to adapt that calculation and say the total for a year is 1.2 million, but we've only had 9 months. And in doing that calculation, I get to 900,000 rand rental income. Righty, so those are the journal entries that relate to our investment property and PPE when the revaluations are done at the beginning of the year. Just putting my calculations in a block so you don't find the memo confusing. Right, then we can move on to the next building, which is called Building Aardklop. So let's see what's happening there. For Building Aardklop, if I read it correctly, it is also being leased out as from January 2015. So again, we are going between PPE and investment property. So it used to be PPE, now we're renting it out, I believe, to the Football Association, and it's becoming investment prop. So let's see, what are the journal entries that we will start with on 1 Jan 2015? Well, the journal entries we have to do for this one again entails that we have to do the reevaluation. So we need to go and check when this asset was acquired. So this asset was acquired on 31st December 2011. So let's see, we need to go and work out, but what is the number of months accounted for depreciation? What is the lifespan? What is the remaining life? That's very important to know when we have valuations that start at, or that are done at the start of the year. Okie dokie. So we're going to say, firstly, we know what is going to happen. We're going to have to eliminate the accumulated depreciation on Aardklop. And we will also have to play it off against Building Aardklop. We need to do a calculation to see what it was. So I'm counting the months, and the first count will start on 1 January 2012 to 31st December 2012, because this asset was obtained on 31st December 2011. That gives us a whole 12 months. Then we have 1 January to 31st December 2013, which is another 12 months. And we also have 1 January to 31st December 2014, which is another 12 months. If we add all the months together, the accumulated depreciation that's being accounted for is a total of 36 months. The lifespan of this asset, again, is 25 years. In other words, 25 years at a total of 12 months gives us 300. So what is the remaining life? 300 minus the 36, the remaining life is 264. So now we can go and calculate our depreciation based on the cost price of this asset. We are told that it was purchased at a cost of 18 million and the building was revaluated to 20 million. So we're going to take the 18 million, we're going to divide it by the total lifespan, which is, you can either say 300 months times 36 months, or alternatively, you can say 1.8 million divided by 25 years times 36 months, which is 36 out of 12. And that should give you the exact same answer. The depreciation that I get to 18 million divided by 25 years times 36 out of 12 gives me 2,160,000 Rand for the accumulated depreciation. Now we need to get to the carry value of this asset so that we can determine whether we have a revaluation surplus or we have a revaluation deficit. The carry value of this asset will be the cost price, 18 million, minus all the accumulated depreciation of 36 months that we just calculated. So the cost price or the carry value based on that cost price is 15,840,000. This asset had a fair value on the date 1 January 2015 displayed as 20 million. You will see it is given on 31st December 2014, but the last day in December and the first day of January exactly the same. So it's 20 million. The difference, it seems like an upward valuation, so this will be our surplus. And we're going to recognize the surplus by saying I increase building Aardklop. And I recognize a revaluation surplus. And this is the total, 4,160,000. Right, wonderful. It goes from PPE to investment property. And for that reason, we need to go and recognize it as such. You will see that it became investment property on 3 January. So obviously we are not going to account for depreciation for 3 days. So we will simply here transfer it. You would find we did account for depreciation in the previous example because there were a few months difference between the revaluation and the fact that the asset became investment property. Now it's a question of days, and the smallest amount that we account for in accounting is 1 month. So on 3 January 2015, we're going to increase the investment property and we're going to decrease building Aardklop, and it was a value of 20 million that should be transferred. Right, then we still have to account for the rental income. So on the 31st of December 2015, we will increase the bank or the debtor. and we will recognize rental income. And here we now need to go and count the months. We have rented it out from 3 January to the end of the year, which is a full year. In other words, we're going to say it's 100,000 Rand a month times 12. Great, and that seems to be the entries that need to be done for building Aardklop. In 1.3, we still have a head office that needs to be accounted for. And the head office seems interesting because they don't revaluate it according to this question. They simply say the remaining land and buildings was purchased on 1 January 2007 and it represents the head office. So now we need to go and do a calculation, but luckily we were given the cost of land and buildings so we can go and see what the remainder is. So we're going to start with the calculation by saying total land and buildings at cost was given to us as a total of 49 million Rand. And now remember, we have to work with cost. So what was the cost of Sunnyside? The cost of Sunnyside, I believe, was 8 million. So I'm minusing that. And then I also have to minus the cost of building Aardklop. And that was a total of cost of 18 million. So the remainder cost price should be the head office. So the head office at cost is 23 million Rand. Right, it is not revaluated, so this should be quite an easy calculation to do. The only thing we can do is we need to depreciate it at the end of the year. So on a 31st December 2015, we're going to recognize depreciation and accumulated depreciation on the head office. We will simply take the 23 million and divide it by 25 years. We've had the asset for the full year because we've had it since 2007 and we only count for depreciation 1 year at a time. So total depreciation there, 920,000 Rand. Great. The only thing that now remains is our investment property in Mafeking. So in Mafeking, we have an investment property, and it seems to me like it's not moving from PPE to investment property or investment property to PPE. If I look at the question, they simply tell us the rental income and that it was revaluated to 15 million. So at the end of the year, we're going to recognize some rental income. So again, bank or debtor. And we will then credit rental income. And we are told that it is a rental income of 2.1 million Rand per year, and we can use it as such because it's been rented out since 1 January 2008. So it was rented out for 1 full year in the current financial year. Just indicating my debits and credits. And then the last thing we need to do is calculate our fair value adjustment. If I look at my cost price of this asset, it's 12 million. And they tell us on 31st December 2015, it's worth 15 million. Therefore, on 31st December 2015, I'm going to recognize that the investment property is increasing in value. And we are going to have a credit entry for fair value adjustment. And this is, of course, an income. Had it been on the debit side, it was an expense. What is the difference here? It's the difference between 15 million and 12 million. So that should give us a 3 million rand increase. Right. And that was the journal entries that had to be done in terms of this question, NPD. Quite interesting. I especially like the fact that it is revaluated at the beginning of the year. Quite an interesting question. I hope that you have enjoyed this video. And then, of course, I will see you in the next explanation.